Hi there, and welcome into this week's market update on the 27th of July. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself what is appropriate to you. So today our market managed to create a all-time high. So we've pushed finally through that 74 level, closing not quite at the high of the day, but at 74.31. So at this stage, it's a very good sign that this longer term trend is still intact and there is a willingness to push this market further higher. And look, at this time of year, it's quite often we do see a bit of bullish movement into the reporting season. So I would suggest that the bullish market could easily continue through August, but then in September, when we start hitting all the dividends, high chance to see a bit of a pullback. September, October usually fairly weak months before we start rallying again into that November period. So seasonally, that's what we generally see. At the moment, there's a lot going on that could easily push things higher. But as we get higher and higher into this trend, we're seeing more and more nervousness around whether markets are getting overvalued or not. At this point of time, though, I still feel our market is fairly well priced. If anything, there's a lot of areas of the market that are still very, very cheap. Okay, particularly around the miners. Miners are finally starting to lift off, though. Okay, so we got Rio's report on Thursday, and I guess with the big push in copper that we've seen over the last week, it's got people excited around the material sector once again. You expect a very strong report out of the miners with increased dividends once again this round, guys. So I don't believe we're going to see a whole lot of selling in that space unless something big shakes the commodity sector. Keep an eye on iron ore. We want to see that hold above 200. So coming across S&P 500, they're also breaking into all-time highs. Okay, so we're actually seeing quite a lot of strength over in the US as well. Long-term trend through here. Okay, that's all holding really, really well. So at this point of time, you'd have to be bullish overall. In the short term, maybe a little bit getting a bit overheated. But every time the US breaks into all-time highs, it tends to have another run of at least 3 or 4%. US reporting has been remarkable this time around, and that's a big part of the catalyst pushing things higher. So we are seeing a lot of markets push into all-time highs. US and here also some of the indices through Europe, so Japan, so yeah, look, a lot of strong marketplaces out there. A lot of that's due to a lot of stimulus that's been splashed around because of COVID lockdowns. Okay, so most central banks of the world are extremely accommodative. Most governments of the world are doing some form of fiscal policy to help, whether it be in some form of COVID aid or whether it be in some form of infrastructure spending to help push their economies forward. So off the back of that, people are expecting a fairly strong few years ahead. Okay, and yeah, I think that's really what the market's looking at the moment is the next year or two. They're not particularly worried about short-term influxes of COVID. Okay, we've seen a huge amount of COVID, Delta strain COVID being daily cases being pretty high. Even locally, right? We've been struggling a bit with this Delta variant too. Look at New South Wales at the moment. But nonetheless, right, what prevails is that there's a heap of free and cheap money out there at the moment. Interest rates are near zero from a central bank point of view. There's plenty of bond buying happening out there, so plenty of support in the credit markets. Therefore, the equity markets should remain fairly robust, right? Fairly strong. So, all right. So all-time highs ahead, guys. We're finally breaking in. Not to say the short term we could have a small pullback at some point, but nonetheless, over the medium term, I suspect we'll head quite a bit higher. US reporting, as I mentioned before, very strong. Even Tesla beat expectations by 50% on their earnings last night. And the last report we heard from them is they were struggling a little bit with supply chain issues and things like that. Yet they still have the ability to absolutely smash analyst expectations, and that seems to be the theme for this reporting season in the US. Most stocks aren't just beating expectations, but they're really strongly beating expectations. expectations, which means the analysts have got a little bit wrong. Okay, I think a lot of the analysts were expecting there to be a larger effect of supply chain issues and slow down, things slowing down a little bit because of COVID. But yeah, things are still very, very strong in the US from a reporting standpoint. Economic data this week could send markets either way, right? So the big one is the Fed announcement Thursday. So Thursday morning, just before our market, we're going to see them release their monthly meeting on rates. Obviously, it's more about bond buying at this point of time. Look, we don't expect the Fed to change any of their settings, okay, at this point of time. We are listening and waiting for any hints on when and how they may start tapering bond purchasing, okay? So that's what we're waiting for. I think the Fed's cooling their heels for the moment, just waiting to see how long this inflation lasts for. I think what you'll find is if this inflation lasts for another couple of months, they might start talking about doing something. Right? If the inflation problem, hyperinflation problem calms right down again, if we get inflation back down below 3 into the 2s, the Fed's not doing anything, guys, right? So let's just see. I think we're in a wait and see mode for central banks at the moment, right? RBA was the same, okay? RBA last announcement, they pretty much told us everything we needed to hear. Interest rates aren't going up anytime soon, and the tapering of bond buying is going to start, but at a very, very slow pace, right? So look, the Fed's likely to do a similar stance, okay? If anything, they probably won't do anything at all for the rest of this year, all right? Until people are vaccinated enough, until the lockdowns are finished, until COVID's under control, you'll find the Fed will sit on their hands. Could be wrong, so let's just see what Thursday brings. It doesn't take much for markets to get scared around this, right? It doesn't take much for investors to start thinking outside the square and start speculating on this, right? You've heard a lot of negativity around the Fed of recent, and a lot of negativity around the inflation at the moment. So not everyone shares the same view as the Fed, so markets can have all sorts of adverse movements to these Fed announcements, depending on what people are reading into the words that are announced from the Fed. So watch out, guys. I'm always on high alert coming into any Fed announcement because it could easily cause a bit of short-term volatility, right? In that, it is usually only short-term volatility, and that pullbacks at the moment aren't lasting long. Okay, so people are very quickly coming in to buy back into those pullbacks, and that's because nothing's actually changing from the Fed. It's just people speculating at this stage. If the Fed comes out with a solid bit of information on when and how they're going to taper, then I might think differently, right? We've also got more inflation data from the US this week. Okay, so let's watch out for that. There's a bit of forward data there in the price indexes and the like. Forgot to mention home sales were a little bit weaker than expected overnight. That's will probably take a bit of the wind out of the sales of the banks and stuff like that in the US at the moment. Tomorrow, CPI from Australia, that's important. Keep an eye on that, guys. Later in the week, though, Thursday night, you got GDP from the US. That's one that we've really got one eye peeled on. Friday, GDP out of Europe, and then also Friday night, as I mentioned, that you got that inflation data. Okay, so a bit to come this week that could really shake the view of markets at the moment. We want to see a strong economy, but we don't want to see it too strong, right, in the sense of inflation. What most people need to understand, the inflation that we're seeing is a lot of it is probably going to be transitory. It will probably calm down very quickly as things finally reset from the very low levels that we saw last year. Okay, so we saw through COVID things slow right down. So 12 months later, when you look at the comparisons, of course, that inflation comes through and appears very, very high from a monthly reading. Okay, so let's just see how that plays out, guys. All right, it's still very early days in all this. Lockdowns, okay, so Vic and South Australia out of lockdowns, okay, so there's still some restrictions on things in Victoria, but generally speaking, you can start moving around again. It won't take long, okay, for offices to be reopened and all that sort of stuff. It's usually a week or two later, but nonetheless, the snowfields are back open, tourism's back open. You can go travel again. There's no 5 or 10k rule. There's no 4 reasons to leave your home. New South Wales is another matter. Okay, 170 odd cases today. At this point in time, it looks like New South Wales is likely going to be in some form of lockdown for the next 2 to 3 months. We need to see those numbers coming down, not up. The trend is up, guys. Unfortunately, they could get up to that 700-800 mark like Victoria did last year. Anything's on the table at this point. It's really too hard to read. So, look, as I said before, I don't think that's going to send markets lower. Okay, there'll be certain stocks that it will affect. There's certain stocks, especially around the travel side of things, that it could affect. But nonetheless, the government has got aid there for people that are losing their jobs or unable to work through those lockdowns, and banks are offering freezes to people's loans once again. So there's no real immediate danger in the short term to the housing industry, markets, or anything like that. So what you need to remember too is a big part of our market really doesn't get affected by that. We've got a lot of exporters on our market, especially our miners. As long as the mining states don't lock down, generally speaking, the market's going to be pretty good. So Oz reporting's around the corner. You got Rio kicking it off on Friday. Then coming into early August, you're going to see a lot of the top 200 stocks report. Okay, so generally speaking, it's a fairly bullish time for our market. I suggest that will be the case this year, considering the sideways we've just seen for the last 6 to 8 weeks. So at this point in time, I'm expecting a strong move up. But as I said, late August into September, you tend to start easing off and having a little bit of a pullback. There's a lot of things happening this year, guys. Okay, so we've just got to keep an eye on the news, keep an eye on our view. That can change on a weekly, daily basis. So, one last thing before I leave this video. I know I've gone a bit too long. The other big thing to keep an eye on is Biden's infrastructure deal. Okay, it's a pretty big deal. A lot of money being spent on infrastructure, and that puts a lot of support for the industrial supplying type stocks and materials. Okay, so that's another big splash of money coming into the economy for the US. That does help some companies worldwide. So just keep that in mind, right? Keep that in mind, guys. Alrighty, I'll leave you there. Thanks for listening in. Take care and bye for now.